2018 has definitely been a more challenging year for financial markets. This has been principally because the Federal Reserve in the United States has been in the process of trying to normalize interest rates. Other central banks have been continuing to accommodate with monetary policy, whereas the US is ahead of the curve in trying to raise interest rates. That's meant that a number of financial assets have found circumstances quite challenging, in particular fixed income markets. That explains why we've been very defensively positioned for global fixed income markets since the start of the year. That said, equity markets have had a pretty good recovery from the lows in March, and May was no exception. Global equity markets enjoyed good returns, and particularly for US companies and UK companies that have US dollar earnings, they translated into higher earnings for UK companies. That means that our model portfolios of the lower risk, both 1 and 2, underperform their benchmark slightly, whereas models 3, 4 and 5, which are the balance to the higher risk models, comfortably outperform their benchmark. Year to date, risk model 4, which is the second highest risk model, is up 2% versus the benchmark only up 1%, and risk model 5 is up 2.3% versus the model up only 1.2%. So we're not complacent about the risks that are faced as the US central bank continues to raise rates. And we're in no hurry to add risk to the portfolios at this stage. We prefer to just maintain a cautious exposure through fixed income, looking to possibly lock in a little bit of profits into the summer, waiting to see how the last quarter of the year will evolve. But overall, we're very comfortable and pleased with the performance of all the Mosaic risk models, both on an absolute and relative basis. But as I said, we continue to just be slightly cautious given the rising interest rate environment in the United States.